Great. Well, thank you so much for joining today. This is our annual bootcamp session for our past winners and finalists to have the unique opportunity to have this intimate conversation with two legendary Silicon Valley investors and our founders, Young and Bill. They're unique in that they've had various roles and have looked at innovation from all different perspectives as investors, as entrepreneurs, very successful entrepreneurs that have built and scaled and exited companies, as well as corporate executives. So without further ado, I'm going to say hello to Young and Bill. Thanks for joining.
Well, thank you. Thank you for joining all of you out there.
Great. This is a very intimate conversation because they have earned the privilege of having this intimate dialogue with you. So I'm just going to kick off by having some leading questions and then get into opening up the floor for their Q&As. So Young, I want you to like you to take us through what's going on in the macro, because there's been a lot of changes over the last 2 years, and building companies today and the funding environment is vastly different from 2 years ago. So I'm going to actually screen share to help drive
that would be great. Yeah, thank you. Okay. So we recently had meetings with our investors on this subject. So I thought I would share with you slides that we have used just so that you get a perspective around probably all the things you are hearing about in the newspapers and others. So clearly there are several things that are happening. Some of them are just too much money that's been printing last several years that are creating a inflationary pressure. To taper that, clearly the Fed is working on increasing interest rates, which is really hitting a brake to slow things down, which has an implication to labor market as well. The labor market is still very tight. There is unemployment rate is not that high, although I think depend on countries, depend on the market, and depend on the sector. And I don't know whether we are in the banking sector turmoil either, given some of the banks that are pretty well funded had a run on it. So I think that we will have to watch that carefully. So overall, the way I will theme it is really ABC. So what is ABC stand for? A, I think at this point, people are really talking a lot about AI. B is really about the banking crisis that has been kind of spooked some of us, including my own. I have a Silicon Valley Bank as my bank, and one weekend I couldn't use my credit card, and that's not a good feeling when you have a lot of money in the banks. And then and you have to wait until that hearing from the U.S. Treasury to supporting all the depositors, regardless, which I think helped a lot to calm down. But there are several banks that's been going down. C stand for U, stand for cash. The cash is king, and without cash, you cannot run a company. So really critical that, you want to have enough cash to go on in a downturn, because great companies have to come out of this hole with enough cash so that, the way I would advise my companies were trying to have enough cash to go on next 18 to 24 months, because that is the kind of cycle we are in. And, it could be shorter, but you want to be prepared for the worst. So that is kind of my, a simple macro perspective on this. You can skip that, you can take it off. I will talk about that a little later, Victoria.
Okay, great. We'll come back to that. But let me go to Bill to dive into fundraising, right? As an investor in this environment, what are you looking at as an early stage investor? What sort of performance metrics are you focusing on?
So it depends on which stage. And early stage, there's obviously early stage and late stage. And within early stage, there are several layers of early stage. At the raw seed level, I'm really looking for team. So I think all of you have friends from high school and college, and you knew who the winners were. and you also knew who wasn't ever going to amount to anything. So I think over people's history, you'll observe, when I look at a raw startup, I'm basically I'm trying to assess a person's judgment and their ability to make good decisions. And so I'm basically looking at a combination of a big market that's going through some kind of a structural change, where a young company has a shot of breaking through in a way that you couldn't in a stagnant market, coupled with kind of just an assessment of the people and their ability to bring together a good team and their ability. So that's kind of the raw, where I'll work with 2, 3, 4-person startups with an idea. Beyond that, it's really looking at product market. I think to the extent that they're still in a market with a structural change, then I'm trying to assess whether or not there's really early indicators of usage or of a product that people really want. And then I think sometimes I'll see really good teams that are in spaces that just aren't happening at the moment. I sometimes will work with companies like that, but usually that's more on an instinct as to timing of when a market inflection may come, or the ability of a team to adapt. And sometimes I'll work with good teams to, so-called pivot them into something else. So, but again, it's at the earliest stage. My objective is really to try to help build an organism with the right values and the right culture that includes some of the things that Young was talking about, particularly in this time, which is an ability to not just fake growth with a lot of capital raise, and because you get a lot of that in bubbles, of course. I think the companies where I've had the greatest multiples or the greatest outcomes have tended to be companies that had a really, really hard time raising money, and therefore set cultures where they really only applied capital to real value creation. And as a result, they tended to get profitable a lot faster than their peers. An example of that might be Canva, compared to a company like Figma. Canva, if I recall correctly, got profitable on about $30 million, somewhere between $30 and $40 million of raise. They, obviously now they're, running about $1 billion in annual revenue, 80% gross margins, 30% pre-tax. The nearest comp is probably Figma. Figma, compared to Canva's, kind of 37 to profitability, Figma raised about 300 to get to about 200 million, maybe a seventh of the size on 10 times the capital. They were acquired for a very high multiple for a bunch of reasons that, Adobe really needed a product because they had tried to buy Canva 7 or 8 times and Canva kept saying no. But I think the capital efficiency matters. And it matters to an entrepreneur. So I'd say, team values culture reigns supreme across all stages of early stage, coupled with a market that can give companies a shot that is also big enough to produce very large market cap. But that's what I look for.
Mm-hmm. Great, very insightful and practical advice, because you both, Young and Bill, have seen cycles through the last 3 decades of investments and ups and downs in this venture market. Young, I want to go very practical advice again. Now you co-founded a $600 million deep tech venture fund focusing on AI and data called Walden Catalyst Ventures. And you've got entrepreneurs knocking on your door and looking for that next round of funding. How should they approach you? And I know VCs don't invest in the company the first few times they meet. So how should they cultivate that relationship with VC investors as you get closer to raising? Because it's a relationship building game.
Right. Well, I think that the first part is very exciting time still. So although the people are getting cautious and there's a lot of money out there. So I want to make sure that if you have a great idea, as Bill mentioned, you can be able to raise money. But it's just much harder than before because people are being much more cautious. So that's one kind of a footnote. In terms of how we go about, there's so many different ways of getting connected with entrepreneurs. Some of them are from publications. Sometimes I would find a company out of a technology review at MIT publication, or sometimes you run into your network of VCs and entrepreneurs. It is easier if someone has done a company before and the person, it improves the ratio much quicker. But if it's a first time entrepreneur, then you need to kind of be there where the VCs are so that you get to know them. And it could be formal, it could be informal, but I think the visibility is really critical to build, because at the end of the day, it's a trust. And because we have to trust the person that Bill mentioned about the companies and team. Fundamentally, without trust, nothing happens because you are giving the money and empowering you to run the companies. So be where the action is, number one. Number two, build the trust. Trust you can build in many ways. You can meet like this and create a trust, but it's hard to get a trust right away. So if there is someone that we already know, that will help you to improve the credibility and trust. If you have done it before, that give you trust. There are certain network, whether school or other industry associations, that helps. Area that we are investing, we tend to invest in AI and data infrastructure. We tend to look at experts that are really the best in that area that we are looking, and we're trying to back them up. So you have to be really good at what you do. Some areas like the semiconductor, for instance, it's very clear who has done it, who has not done it, who has delivered, who hasn't delivered. It's an industry that's been around for a while. So if it's a great idea with a good team, we can be able to check it out very quickly. If it's whole new AI applications, there is probably a bit harder. So then you need to figure out how to validate the concept. And validation means that we need to improve our confidence. And a confidence means that we believe your story, we believe the business model, we believe the team. And it's the process. Typically, it'll take you 3 to 6 months. So you have to be patient, because anything in venture capital is a long game. It's not a short game. Typical exit in our portfolio was 8.7 years. And when I say exit, it means like IPO. We have done over 600 companies we invested. Out of that, 133 of them went IPO. And so we know that over the years, it is a long game. You got to be patient. And even if first time may not work, we tend to, the second and third time, it gets better. So it is a relationship that you probably want to build it for a long term.
Mm-hmm. Yeah, it is a long-term gain, it is a relationship gain, and trust is really important. So I want to go to Bill for one last question, because I know founders are eager to jump in. Down rounds, should founders accept down rounds?
Absolutely, they should, and I'm not.
Oh, you must be on mute.
Oh, am I off mute now?
No, I hear you.
Yeah. I mean, I know it's always a tricky thing, because a lot of startup life is built on building and maintaining perceived momentum. And that I think as you go out and raise capital, if you have a perfect world and you execute well and every round is slightly higher than the last one, it all feels good. Whenever you have a down round, it sometimes feels hard to explain as the leader, because there's a I think a feeling that, oh, well, something must be wrong, or, oh, the company is shrinking in value, or, there's a negativity associated with it. There are external factors, of course, that drive the macro picture and valuations up and down. I think you spend a decade building a company and building a certain revenue and earnings critical mass, and then the PE multiple, the price to earnings multiple, or the price to sales multiple fluctuates extraordinarily in ways that can be more than the company's value. So the swings can be crazy. The vast majority of the publicly listed companies that are in the hot areas in which startups would start, they're probably down 50 to 80%, from the peaks in the bubblish period we just went through. So it's not unusual to have everything compress. So I wouldn't worry about it too much. But most of this game is about survival. You don't want to take money at such low prices that it wasn't worth it at the end. But per Young's point of 8 something years to an exit for the ones that do exit, there's a little bit of a kind of a Warren Buffett thing. Warren Buffett sits on the other end of the extreme opposite end of the world of finance and venture capital, but the best returns come from companies where you never had to sell or never wanted to sell, and you could later. You look at whether it was a Microsoft or an Amazon. I still have my seed shares in Netflix that I've never sold. I thought that thing was going to go out of business 3 times and probably suffered 90% drops 3 times along the way, but the multiple's probably 1500x, because I waited, and so I think I look for those kinds of companies where I'm looking for something that was foundational and that can live through the upcoming cycles, and in the end produce something that is an anchor tenant function for what people do with their lives, or participate in the industry in something that just isn't going to go away. So I don't worry so much. I think it's more important to be in a big market and just to deliver, because this is a world where the opportunities are innumerable and so big. You just have to navigate to the right waves. And if you do well, the outcome is going to be in the billion to tens of billions.
Great, very wise advice. And again, this game is about survival. I got a question in chat. If the startup is just starting out, what can it show to get the first few checks? They're a enterprise SaaS space developing new AI techniques. So I think, Bill, you talked about team, right? Young? Mm-hmm.
I think that, so it sounds like you're looking a new startup looking for the initial funding. So I'm assuming this would be more like seed funding or pre-seed to get you going. So depend on stage, you have a different kind of checkpoint. So early, really hard in the beginning, because someone have to believe in you and write a check. And so there are groups of angel investors, for instance, that you want to present your ideas. For instance, I think that Canva, I think that Bill mentioned, and Melanie Perkins, right? She came to one of our meetup event, and actually in Hawaii in this case, because Bill organized this thing called Mai Tai, where we get together and we do some work in the mornings and kite in the afternoon, and she wants to tag into our network and present her ideas. So and then there are a bunch of, some of us wrote a check, right? And this is how I got started. So you need to kind of go where the potential angel investors are and articulate what you're trying to do. And then once you articulate, get some funding, and then using your POC, you want to get seed funding going. And then after seed funding is there, then you need to really show that you can go to market big time. And to do it, this is where probably Series A comes in. So I'm assuming you are really early, and I think what you want to do is tag into your family, your friends, don't be shy. Just go around where also early investors that has done SaaS business, that understands your business. That's really key too. The people that has made money in your area will invest it again. So go after those people. Not knowing exactly what your business is, that I'm giving you generic advice at this point.
Great, thank you, Yang. Anybody else? You can just raise your hand and raise your real hand or your emoji hand.
I have a question.
Great, Jerome. Mhm.
So my question is, do you assess climate startups the same way you assess tech startups? I'm just curious to see if it's from tech startups, like the same speed and momentum it's needed for climate startups as well, because usually climate solutions are a bit slower. Because I'm just curious, how do you see if they're exactly the same to you or different?
Oh, I think the SaaS is a very interesting term. So we should not misunderstand our business is same. I think really it's about what you're trying to do. And SaaS to me is a business model and how you collect your compensation for your service. And there's a recurring revenue stream that you're getting as a SaaS business. Typically, it takes a longer time to get it going because eventually people want to pay you. Zoom is a great SaaS business today, but they launched it in a way to B2B that took time, but they accelerated with B2C business by having the personal users to do it. Both Bill and I are very happy to be the investor of those. But there are other business where maybe it'll be a much longer time taking business. So for instance, chip business that we are in or software business I'm in, those things typically takes much longer to get to break even. So you need a patient investor for that type of business. So you need to get an investor that understand your profile, what you're doing, that'll help you to what I call resonate with what you're trying to do, and therefore they have a better coupling for your mission and your values. And I think that's a very important part of your own due diligence.
Let me chime in on the climate part of that, Jerome, because I think you're right. Climate stuff, it's a little less defined than kind of the standard product markets that you see in kind of silicon or SaaS or hard tech and kind of the routine formulas now for consumer mobile things. And I think because they are taking on a big problem, they tend to be as capital intensive as well. So I'd say I use a similar framework, meaning that I need the right kind of team. I need to understand the problem they're trying to solve. But I also, in those cases, have to get my arms around the financing risk, right? So if you think about the main risks you have market risk, team risk, financing risk. And your job is basically knock those off one by one by one. Often with my little companies, when they're starting, I'll do a whiteboard session with them to have them lay out the 10 things that could kill them. And just like bum, 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 bum. And then, you keep that in your mind as a framework for if you can eliminate all 10 of those, by definition, you're alive at the end. And so with the climate oriented things, the capital intensity is so big, you need to have kind of a financing plan to get through those. Like if you look at the companies, they're not necessarily climate per se, but a representative example of companies that really went through, kind of hard times raising money, whether it's Tesla or Plug Power, it's billions of dollars in some cases. So the one that I guess is nearer and dearer to me was seeding a company called Power Ledger, which was, bringing to market a totally new way to do distributed energy production, revolutionary if it works in probably one of the 3 largest industries ever in history in the world, which is the electricity market, and not easy to take on as an early stage seed investor, but we did manage to pull off an ICO for them to do a tokenized thing. So I think the equity capital raised on that thing is only maybe 6 million, but we managed to pull in like 110 million US equivalent of other things. So it's a raw startup with 100 million in cash equivalent that is going after these big markets, but very penurious along the way. So that money's lasted for 6 years while they're delivering these solutions to governments and electricity providers that we knew the sales cycles might be 5 or 6 years, and right on track for that. So they're finally getting traction after all this time, but they still have 50, 60, 70 million in cash. So you just have to match the financing risk to what you're doing and understand what it is, how to get to a milestone where you've shown value to show that you're making progress towards a big outcome. And if the outcome's big enough and people see progress to that, there's usually money available. Not easy to get, but it's available.
Great, thank you, Bill. Lee, jump in.
Thank you. Bill and young Lee Dowie from Foundat. I just wondered if you had any advice for the international tech startups whose ultimate goal is, to establish themselves in the US, primarily for, positioning with, similar technology providers and financing. But the engagement we've had to date, really suggested that a lot of the VCs are looking for startups to establish themselves in the US first before they'd engage in those sort of discussions. But it seems like a very risky proposition for a startup to go and, uproot and set themselves up in the US early. Do you think that that's a good idea, or would you caution against that?
I think that depend on your business, obviously. And I actually have exactly the case that I'm discussing with a company, Israeli company called AI21. It's an Israeli company, AI company. Now we're discussing the setting up US presence, and it's already 200 people company. So they didn't have to do that until now. They financed it in the Israeli market. Actually, we led the round, so clearly US investors that are willing to do it. So I don't think it's a formula that you have to do it. I think depend on your business, and they actually generate business in the US, but now big business is big enough and the hyperscaler relationship is strong enough. They want to have a local presence, and also AI is so hot. You have to be where the action is, otherwise you're going to miss out not only sales, but also just the news and the media, the coverage, and all those things. So you don't have presence. So I think presence, business, there's certain timing. Also, you got to have affordability, and that's also very important as well.
Yeah, fair enough.
I do think it's important close to your customers, close to your market. I think depending, as Young's saying, depending on the type of business you have, the more physical the product is, it's obviously better to have in-person ability to sell. I think the digital age brings with it a different kind of reach. Canva's a great example of a company that was founded actually in Perth. We ended up moving it to Sydney for recruiting purposes because we just couldn't hire the scale of talent we needed in Perth, but we incorporated the company in Delaware. So it was a US legal entity, but the physical bodies were mostly in Australia, later also in the Philippines and a bunch of other places now. But I think the legal framework is one element of it. The other is, where are your customers? The other is, where are the people that you need to build the product located? So I'd say I'd take all those into consideration, and it's kind of a multivariate equation that you optimize for. But I think increasingly it's possible to build companies not based in America. It was especially 2 years ago with the bubble, but I think it was for the first 20 years of my venture career. It was common wisdom, whether you call it wisdom or not, that you'd only, Don Valentine, who was one of my early mentors, he started Sequoia Capital. He was on my board of my first startup. He would always say, never fund anything more than an hour away from your office. And I stuck to that for a while, because he said, why bother? All the big hits are coming from here anyway. Why do you need to waste time traveling? And years later, when I funded Zoom, that gave me reach in a way that, was unbelievable because none of the other firms are funding stuff outside. So I had a field day for a while, but now everyone's kind of in a position to do whatever I do too. So I worry about that.
Excellent. Well, thank you. And hopefully we'll see you at West Tech Fest again this year, Bill.
Absolutely. Well,
Let's go to Dennis and Brittany. We're down to the last six minutes. Dennis?
Thanks. I wanted to ask if you have any specific advice for startups that are doing hardware with long development lead times. So for example, commercialization of the product that we're working on is at the minimum 3 years away, and we're looking for investment, but investors are primarily looking for you to, start getting recurring revenue within a year if it's in software or earlier. But we're a long way away from that, and it's hard to attract anyone with our value proposition.
That's a good question for Yang.
Yeah, so deep tech in actually is a similar kind of issues, right? Because typically you're trying to change fundamentals and it takes a long time to evolve business, particularly like infrastructure, changing the whole network infrastructure, bring in new capabilities that are doing a long haul communication, bring us semiconductors that are creating a competition to NVIDIA for accelerating the AI applications, or building compilers that can enable CUDA like capabilities in a chip. These things takes a long time, takes a lot of money, or sometimes just it requires a lot of patience. So what I learned on that is that don't waste your time with the people that are looking for short-term return. Just it would not be a good match. So you got to know who you're talking to. And then second thing is that there are certain people to go to, like in the semiconductor industry. I think that's probably where I'm pretty most well known, along with the Lip-Bu. Most some ideas will come to us because we've been doing it so long. Just like that, there's also the guys that are doing on long haul communications. So so there's certain people that are specialized or looked at as for long-term investors that are not worried about short-term need, but getting the right investment matching is really critical. Otherwise, you'll have a very disappointing board experience. I don't know your particular business, but since it is hardware, you have to think about your business model, how you're going to get paid, and how do you pay for upfront, your fixed costs. So financing is also a very important part of the discussion.
Thank you. Brittany?
Yeah, hi, Brittany, founder of SADU, the lending protocol for sustainability linked bonds. And right now, the, let's say, two things I'm debating the most is A, hiring and taking more advantage of, let's say, new talent that's coming on the market, which would obviously shorten the runway, or B, extending the runway and building a bit slower. So given, and this would be under an 18-month runway. So it'd be great to hear your feedback on whether or not to, put the pedal to the metal or to perhaps, I don't know, take a bit more time for R&D.
Well, that's a tough one. Every situation's different. I think every sub-market goes through different financing cycles inside the bigger cycle. We're obviously in a tougher market now than we were a year or two ago. So that kind of places a little bit more weight on being a little conservative. But I'd say in the end, companies are really just teams. And great companies are teams of great people. And so you never want to pass up a key ad that is going to move the needle for you, right? Because I think, you kind of sink and swim together, and the better your team is, the better the chances are that you're going to be able to raise if the market is the right product market. So I'd say I'd assess it based on quality of person and whether you think that person is going to move the needle for the business or not, and create value soon. If so, then I'd always go towards hiring.
Yeah, I think there has been overhiring in industry because there's so much money chasing. It's turned, so you have to even more selective. But I think probably because of that, you have a better chance of hiring better people, because less competition. But obviously, you know, as you're building your company, you need to make sure you have enough cash to go on. And I was saying earlier in the beginning, given current macro, you know, I think it'll be important to have, you know, enough cash to survive the cycle, because I've seen great companies running out of cash too. And so you need either you have to have the cash or figure out how to get more cash. Or if you have enough cash next 2 years, then hire great people. So in that order.
Great. I'm going to sneak in one last question. As a company is scaling, there's a need for CTO. How do you find a fractional CTO?
I think CTO is tighter. I think the key is really someone that has an expertise in the technology or the space that you're looking that can complement the team. So, I mean, there's a lot of title inflation, right? CTO, CMO, see everything. But I think that I like flat organizations. I like organizations that everybody owning it as if it's theirs. And the title just comes after the fact.
Great. Anything to add, Bill, before we wrap up?
No, yeah, CTO is a tough one to fill, and part-time of anything is a tough. It's yeah, I'd rather have somebody that, you know, wasn't I'd rather have somebody full-time, obviously, that's just hustling and maybe younger, maybe a little inexperienced, but then somebody part-time if I could help it. You know, I mean, sometimes you'll get great executives out of a company that have made a big name for themselves that will step in and do it, you know, for part-time, that are recognizable. Sometimes that will work, but it's hard to build any company with people just part-time.
Very sage advice. And I want to thank Bill and Young for creating this amazing community called Extreme Tech Challenge that will foster these connections and conversations and really help to find amazing companies and then give them the rocket fuel to help them scale. So thank you so much for all the founders who are joining us today. Stay connected to our social media, LinkedIn, Twitter, stay connected, follow Young and Bill, and we'll be uploading this recording for folks to rewatch it. So thank you again. Have a great rest of your day.
Cheers, everyone. Thank you very much.
Bye.
Thank
Bye.
you. Bye-bye. Bye-bye.
Bye.